Okay, welcome back to the show, everyone. I'm Charles, and today I'm here with Mark Moss, serial entrepreneur, investor, and an advocate for hard money like Bitcoin. He's here to tell us all about his professional journey, what he thinks will happen to Bitcoin next, and what to expect in 2026 from the US government and the Fed as it relates to markets. Mark also works closely with Larry Lepard, whom we've had on the show. So we'll be talking to him about what he sees as the potential next big print, how that's coming, and the future of corporate balance sheets turning into Bitcoin. Mark, let's jump in it. So happy to have you on the show with us.
Yeah, thanks. I'm looking forward to it. Let's do it.
Okay. Mark, can you start us off with a quick overview of your background? What did you study in school? Where did that take you initially professionally? And then tell us how that eventually led to your aha moment in Bitcoin and the work you're doing in the space now.
Shoot, that's a lot of ground to cover. So let me give you the super high level, fast forward version of that. As far as what I studied in school, I studied how to cheat and get out of high school barely. Now, I don't have any formal education. I didn't go to university. My parents wanted me to go to university so bad, and it just was not for me. And so I just learned how to start making money. And that's what I did. I just focused on making money. Right out of high school, I started buying real estate. I started buying bank-owned properties. So in Southern California, where I live, we had gone through this big depression. The banks owned all these properties, and they were literally giving properties away zero down. Just take them, please, take them off our books. And so I started buying properties, fixing them up, flipping them, and I had one job ever working for my friend's dad's company, which was an engineering company that they designed this medical device. I worked there for a couple of years, and then as I was doing the real estate on the side, working there, I quit and I started a medical equipment company. It was high tech medical equipment. Specifically, it was like a digital X-rays, paperless offices, and digital cameras. I started a company, and then I also all simultaneously started another company, which was one of the very first online e-commerce businesses in the action sports industry. Anyway, so I was kind of building all those simultaneously. I had two big exits. I sold the high-tech medical equipment company to the largest medical company in the world, Henry Schein, and I sold the internet business as well. Pushed all my chips into the real estate arena, and that was right around 2006, 2007. And I sold all my businesses, had no cash flow, had no income. All I had was a bunch of real estate in California. And when 2008 came, it took a 60% haircut inside of 12 months. And that was devastating for me because I didn't have the income, I didn't have the businesses, and I had a bunch of real estate that was 60% underwater. And of course, it was levered 30 to 40%. I thought that was pretty good, but it dropped 60% in 12 months. Had never happened in history. The biggest drop in history in a 12-month period was 6 months. I'm sorry, 6%. So I planned my numbers for triple the worst in history, 18, 20%. I could stomach that. It dropped 60%. So that's how bad it was here in Southern California. And that wipeout forced me to go, what the heck just happened? Like, I'm pretty good at business. I figured out how to make a bunch of money. But I'm not paying attention to this global financial macroeconomic system that has all this power over my life, and I'm not putting any attention to that. So, it's funny when I tell this story and people are like, why would I listen to anybody who lost a bunch of money? Because success is a terrible teacher. We learn from mistakes. Smooth seas never made a skilled sailor. So anybody who's pretending like they've never taken a loss, they've never tried anything. And so it was that pain that forced me to go, shoot, my family just got wiped out. My wife doesn't know what to do. My kids don't get a birthday. I need to go figure this out. And so it put a lot of pressure on me, but a lot of urgency on me to go figure this out. And so, dust myself off. Let's go figure it out. And I've spent the last, whatever it has, how long it's been now, 15 years, just studying the macroeconomic system. I quickly discovered that it was fiat money that was the problem. I quickly discovered it was the banking system and the leverage that had got built up in there that was the problem. And I say that because once you understand the problem, then you can start to understand solutions to the problem. And so what I realized, well, if it's fiat money and it's leveraging the banking system, that's the problem, then the solution became pretty obvious to me, and it was gold. Gold was sound money. So I became a gold bug. Started, like I said, started studying the macroeconomic system. I started investing into all types of investment newsletters, which I think are the best investment you can make. Investment newsletters,
And
because
Mark,
you
what
learn
year
about.
are we at right now?
Well, this is now 2009, 2010.
Okay.
Um, and so I started investing in investment newsletters and taking as many classes and reading as books as I could, trying to figure that out. And around 2013 was probably the first time I had heard about Bitcoin. Like most people, hearing about it and buying it are typically two different dates. And at the time, my business partner at the time, being a tech investor, the technology piece, appealed to me pretty quickly. But really, I didn't really understand the tech of Bitcoin. It was more just like the price is going up and to the right. And so my business partner at the time was like, "Hey, we should buy this. We should buy this. We should buy this." And it was just going higher, higher, higher. And it got up to, I think it was like $1,000, and then had that spectacular crash. And I was like, "Oh, glad we didn't buy it." Around 2015, I was still sort of in PTSD from the banking collapse that happened in 2008. And I was subscribed to this investment newsletter called Sovereign Man. And the thesis of Sovereign Man is to be a sovereign man. It's really flag theory. It's like, you wouldn't put all your money in one stock. Why do you have your whole life in one country when you don't have to? Why not have bank accounts in multiple countries and trust in multiple countries? And why not have multiple passports? Like, why not just be sovereign? And so I was actually working with an attorney in the network at the time to establish a residency in Panama, get a bank account going in Panama, because I was trying to get money out of the banking system. I still thought the banking system was fragile. I thought another 2008 collapse could come because the system didn't get fixed. It only got worse. And so I was trying to get money out of the banking system. But the thing is that, was it really getting money out of the system? Because the global financial system is global. And so around 2015, I was working with this attorney, and I took another look at Bitcoin. And it was like, wait a minute. That's what I'm trying to do. I'm trying to get money out of the system. And I tell that part of the story because so many people today, smart people, wealthy people, prominent people, you'll see them all online saying, but what's even the use case? And why is there utility? And why is there even a need? And it's because they don't understand the problems that we have.
Yeah.
I mean, you have a little bit of a chuckle, but they don't, right? I mean, I'm in New York City living in my $5 million condo and drinking $20 Manhattans. And like, you don't really understand the problems that people may have in Afghanistan or North Korea or whatever. And so only because I understood the problem, and because I was actively this is a key piece, because I was actively looking for a solution to my problem. You've heard the story of Michael Saylor, I'm sure, quite often. He talks about in 2020 how they came around to Bitcoin. He had $500 million and he realized it was a melting ice cube. And he's like, what are we going to do with this $500 million? I have an acute problem. I need to do something with this $500 million. I am going to go look for all the potential solutions so I can find one. So it starts from that point. And so all these people online, they're like, what's the use case? They don't have a problem. And or they don't have a problem that Bitcoin fixes for them at this point. And so for me, that was my problem, trying to get money out of the banking system, trying to sort of distribute that risk. And that's when I took another look at Bitcoin, and it just clicked for me. Oh, this is exactly what I'm trying to do, get money out of the banking system. And so I started buying Bitcoin. Shortly after that, once you start putting money into Bitcoin, you start kind of paying more attention to it. I started realizing, like, wait a minute, this is like a tool that we can win. Like, we can change the world with this. And so I had to start talking about it and telling everybody about it. And basically here we are today. I've never shut up since. And here we are.
Love it. Love it. Well, thank you for the story there. I was hoping you could talk a little bit more about you actually, bouncing back from that situation in '08. And I believe I've also heard you mention in one of your other podcasts, one of your other shows, that you actually experienced a setback financially twice. So I'm curious, in the second instance, what do you think you missed that time around, and what steps have you taken now to ensure that this doesn't happen a third time, and that you actually can stay a sovereign man, to your point?
Yeah, I don't know about the second time, but what I would say is that there's always losses. I mean, so I don't know if there was like no second 2008 type event in my life, but sure, I've taken losses, plenty of losses. I've lost tons of Bitcoin. I've gotten Bitcoin hacked off of exchanges. I've lost Bitcoin that was on my phone. I mean, so losses are part of the thing. I'm a partner, as you mentioned earlier, with Larry Lepard. We're partners in a fund, Bitcoin Opportunity Fund, and like, not 100% of our investments win. We lose money there, as do every investor, right? Most of the famous investors, the Warren Buffetts, even the GOAT, Stanley Druckenmiller, only have like a 50, 60% win ratio. They're losing 40% of the time. So we're taking losses all the time. And that kind of goes back to what I said earlier. Like anyone who thinks that they don't take a loss, they've just never tried anything. There's never been, even the greatest of all time, Stanley Druckenmiller, still is losing, 40% of the time. So, there was no second like 2008 event, but sure. I mean, I've had businesses that didn't work out. We've had investments that didn't work out. We've lost Bitcoin certain different ways. But to answer the question, sort of like, what am I doing to make sure that I don't repeat the mistakes of 2008? I think there was a couple key things in there that I learned. They were, painful lessons, but unfortunately, some lessons in life can't be taught. They can only be learned. And so I think a couple of them. Number one is learning how to use leverage the right way. So leverage is a tool. And when I talk about leverage, in this instance, specifically debt. And so debt is a tool. It's not good. Debt isn't good. Debt isn't bad. That's a tool. And like any tool, you can use it good or bad, wrong or right. And like a knife, you wouldn't want to give a knife to a little kid because a little kid could really hurt themselves. But hopefully, as you grow up to become an adult, you learn how to use a knife. And even though as an adult, sometimes you might accidentally cut yourself, it might be a little painful, but you're probably not going to kill yourself with it, right? It's not catastrophic. And so debt is like that instrument where it's like, Dave Ramsey wants to tell people, just don't ever use debt. Don't ever, just pay off your debt as quickly as possible. Get out of debt. And that's right for about 95% of the people because they don't mature and become adults. But we should learn how to use it, and we should learn how to use it safely. And just like fire, cooking on the barbecue, I've burned myself on the barbecue before, but I don't kill myself. I don't burn my house down, right? And so, again, you're going to take a loss. Just be okay with that. So I think number one was using leverage. So a couple things. Number one, because we live in a debt-based monetary system, we're not in an equity-based system. We're not in a gold system. We're in a debt-based monetary system. That means money is created through debt issuance. That means if you want to build your wealth, you need to use debt. Now, you can try to save your way to wealth, but how's that working out in an age of debasement? It's not very good. So if you're listening to the Dave Ramsey's, don't use debt and just save your money in your mutual funds, like you're just never going to make it. So really, to build wealth, we need to use leverage. Look at Michael Saylor and Strategy, for example, right? Back to that example, he had $500 million, $500 million in 2020. The company, MicroStrategy, was worth $3.6 billion. That was the market cap, $3.6 billion. Today, $100 billion. How did he get that so quickly? Well, he used debt.
I think Jim Cramer called him like Houdini or something.
Well, he used debt, right? So we want to use leverage, but back to 2008. So I was using bank money in order to build out my real estate empire, right? So I had built, building mixed use buildings, commercial buildings, condo buildings, to build up really quickly. But then I owed money on that, right? So I was trying to keep about a 60 to 70% loan to value, meaning about, let's say for every $10 million, you owe $6 million on the $10 million. So that seemed okay, right? But the problem was, how long can you cover the debt? One of the first rules in investing, one of the most important rules, Warren Buffett says don't lose money. But really the most important rule in investing is never be a forced seller. Never be a forced seller. And what happens is when you use the leverage and use the debt, how long can you carry the debt for? You see, volatility is a tool that we can build with, we can use, but we can also get wrecked by. I just did a show with Simon Dixon the other day, and he was talking about how the elite, or they, or whatever you want to call it, they use volatility as a way to steal and concentrate power. So in that 2008 collapse, this building that we're in right here, I built this building. I had it for sale for $12 million. When the market crashed, like I said, it crashed so fast, I had an offer at $11 million. I turned it down. My payment was like $180,000 a month on this building. I couldn't carry the payment. Why? Because I had sold all my businesses. I had no income. So how am I going to cover the payments? Ended up going back to the bank. The bank sold it for $4 million. Today, the building's probably worth 20. So I was a forced seller. I couldn't cover it. I was a forced seller. If I would have held it, Look how much money I would have today, right? So the same is true on anything. I could borrow against my Bitcoin, but can I afford to make the payment? If so, and the price drops, so what? I can make the payment. I can cover the margin. If I can't, then I risk losing it. And so that's like learning how to use the margin, learning how to use the debt. So that'd be the big thing. The other thing I would say that I'll sort of just add this last one is operating with a safety net. And so, a lot of early, we may call them plebs, smaller Bitcoiners, they think, and just investors in general, they think in terms of things being black or white, like they lose nuance, like it's a switch, like it's on or off. So it's like, in Bitcoin, we have the meme, like sell your chairs, just like all in on Bitcoin, sell your chairs, right? Buy
I
it,
thought it
just
was
buy
sell your
Bitcoin, right?
arm, man. Your other
Yeah,
organs.
but if you look at Michael Saylor, I've been to his house a couple times. Out front of his house, he's got
chairs.
he's got 3 yachts, and he doesn't just have one house; he's got multiple houses. As a matter of fact, I saw his condo in D.C. Like he's got you own more things, and so my point to this is like I didn't have to be all in on real estate. I could have kept some businesses. I could have kept some of my cash flow in rentals, but I put all my chips and just slid it in all in. And I could have kept a couple pieces outside of that for safety. And so that was the other big lesson that I would say.
Gotcha. Appreciate the lessons there. Kind of related. You've talked about an entire video. You made an entire video talking about a potential once in a lifetime crash that is coming, potentially worse than 2008. Obviously, you experienced that. You talked about what that was like and the lessons you've learned. Since you're saying now that the bubble could potentially be money itself, can you help us understand your thesis on that and what the implications will be for stocks, Bitcoin, and other assets?
When I say there's a crash worse than 2008, there's a lot of nuance to that. And so let's define what crash is, first of all. So what most people think of as a crash is, like in 2008, for example, is the stock market dropped 60% in value. Homes, as I said, here in Southern California, dropped 60%. Gold went down 30%. That means then people had less money, so there was less spending. So then businesses fell, right? Businesses didn't have as much revenue. And what happened is when your home drops in value and your stock portfolio drops in value and your business doesn't bring in as much value, the quality of your life drops because your purchasing power declines. You can't afford to go out to eat as much. You can't afford to buy the new car. You can't afford to go on vacation. So my quality of life goes down because my purchasing power declined. So the crash means that my quality of life dropped because I can no longer afford the things I used to afford. What I am calling for is a reverse market crash, where instead of everything cutting in half, everything doubles or more, which sounds great. But for most people, the outcome is the same. Prices went up so fast, I can no longer afford the same house I used to afford. I can no longer afford to drive my car as much as I used to. I can no longer afford to go out to eat as much as I used to. I can no longer afford to go on vacation. And so the outcome, being my quality of life going down because my purchasing power has declined, is the same. But instead of prices going down, it's because prices went up. And the reason why I say that it's worse than 2008 is because what happened in 2008 is it reset the system. Prices dropped 50%. So this new generation got a chance to come in and buy assets at a discount. They were able to buy stocks at good valuations, buy homes at good prices. But when prices just keep going higher, there is no reset. People just continue to get further and further and further behind. And that's why I call it worse than 2008.
What do you see as the potential trigger for this and even the potential timeline for this to occur?
Well, there's no trigger. It's not an event. It's a process. And the process is, as I said earlier, we're in a debt-based monetary system. And so because we're in a debt-based monetary system, that means that money is created through debt issuance. When I get a house, a car, a boat, loan, whatever, that money is created through debt issuance. And the money, the dollars that are created, is the liability, and the debt is the asset. The debt is the asset. And the debt is the asset that's collateral for more debt. That's collateral for more debt. That's collateral for more debt. And so the debt becomes the asset, and the collateral base has to continue to grow. The collateral base can't decline because it's collateral for more debt. Everything would be margin called. So that means the system has to constantly expand, which is why the government keeps printing money. The central bank just switched from tightening to easing, has to put more money into the system. Why Larry Lepard calls for the big print. We have to keep pushing it in. And, really things changed in 2008, right? If you look back previous crashes up to 2008, and this is why looking at older financial data doesn't really give you a complete picture. Up until 2008, even in 2008, they were trying to allow the system to deleverage. Like, hey, the banks, crashed and they made a bunch of risky loans and let's just let it kind of deleverage and see what happens. But there was already so much leverage in the system that it crashed the entire global financial system. And they capitulated and they had to throw in, we got the launch of quantitative easing, and we saw the Fed balance sheet expand by 6 or 7 times. And now the leverage is so much greater that in 2019, when we ran into the repo crisis in September 2019, Jerome Powell tried to do some tightening, tried to allow the system to normalize, but it crashed so hard and so fast that they had to start putting in money into the repo market overnight. It started, I think it was $50 billion overnight. And within 6 months, it was $1 trillion a day. And then when the 2020 COVID crash came, they put in another, $11-12 trillion. So the leverage is so great in the system now that there's no deleveraging that's allowed to happen. And we can just look at this, for example, let me give you some timelines. In 2008, it was a banking collapse, right? So you had basically one of the biggest bellwethers of the market is the housing industry. And so you could see that in 2006, home starts had already dropped by 28%, meaning new permits that were being issued and new houses that were being built had dropped 28%. That's a bear market. Okay, that was bad. It took almost 3 years, 30 months before the bailout happened. Now, most people would point to the collapse of Bear Stearns and Lehman Brothers as the actual point that collapsed everything. From the time that bank collapsed, it took 7 months to get a bailout. 7 months. Now, if we look at 2023, just for contrast, 2023, well, let's just stop it. Let's go to 2020 first. In 2020, you had the collapse in 2020 when they shut the economy down. Within weeks, the Fed had put together over 8 figures, about $11 trillion of stimulus. They started setting up all these SPVs to buy all types of assets, including stocks, to prop up the market everywhere. The government was dropping helicopter money, sending stimmy checks out to everybody. That was in weeks, not 7 months, in weeks. Then in 2023, when the banks collapsed, we saw 3 banks collapse. When they started raising rates so fast in history, all the collateral dropped. We saw 3 banks collapse. They had a bailout in 6 days. We went from months to weeks to days. So there is no appetite for deleveraging at this point. The system is too big to deleverage. And so what is the trigger? I mean, we're past the Rubicon. We're already past the trigger. It's a process that we're in. It's an escalation. Now, of course, nothing moves up in a perfect straight line or ever drops in a straight line either. So, right now we're in a little bit of a liquidity pocket. And, we saw the longest government shutdown in history. And so that stopped some of the fiscal spending that was happening. And so there's a short-term little liquidity drop. But the longer-term picture is up and to the right.
Gotcha. So the trigger happened where it's an evolving process, and then this big print comes. Larry talks about this in his book. When do you see that happening in terms of the government potentially stepping in, or the Fed rather stepping in this time, and how big do you think that can be? And again, what impact do you think it'll have on asset prices?
Yeah, again, right. So for me, I don't fully align with the premise of that book. I agree, of course, with Larry. He's super smart. The book's amazing. But we both agree on the big print, but I don't look at it as an event. Again, I said it's a process, right? So when will that happen? It already is. And that's kind of the point that I'm making, right? So the Fed if we go back to 2020, right? So the Fed couldn't get inflation. They couldn't get the money up. And so Jerome Powell said, we're just going to let it run hot. We're going to overshoot our target because we don't know what it's going to take. So let's just start dumping money in. We're going to overshoot our target, quote, let it run hot. And it did. The economy started running hot. Inflation started raising. He said, we're not even thinking about raising rates. If you remember that. And we're not even thinking about raising rates. He said, we're not even going to think about raising rates for 4 years. Well, things got way too hot. CPI inflation got to 9%. So in November of 2021, Jerome Powell came out and said, whoa. Okay, I know we said we're not thinking about it. I know we're not going to do it for a couple years, but we are. We're going to raise rates. We have to. Now, that's part of what's called forward guidance. So they didn't raise rates in November. They raised them in January, but Bitcoin started selling off, and the NASDAQ started selling off. The S&P 500 sold off a couple months later. All right. Now, what we're seeing now, so then they went on the fastest rate hiking cycle in history, right, from 2021, doing, instead of quantitative easing, rate increasing the money supply, they went to tightening. So tightening the money supply. They did that by raising rates. They did it by letting bonds roll off their books. Instead of buying them, they let them expire. That just changed. When? Today, right now, at the time of this recording, is 12/19. That ended 12/1. That ended 18 days ago. So 18 days ago, the Fed officially switched from quantitative tightening to quantitative easing. But they didn't just switch from tightening to easing, which they did, and that's a big enough piece. But what they did on top of it is then they immediately announced that they'll be buying $40 billion a month into the market. So
can you put that into perspective for us? Do you know how much they were printing or adding to the market during 2008, during that crisis, and during 2020?
Yeah. Well, I mean, in 2008, to bail out the entire global financial system. So it crashed, right? I told you they waited 7 months to get the bailout. They put together what's called the TARP package. And the TARP package was $700 billion to bail out the entire banking system, $700 billion. So today, starting at just $40 billion,
that's a lot.
It's like
5% or so.
5% of what it took to bail out the entire system. And this is what they're just starting on a monthly basis. So, I mean, that's kind of give you a little bit of perspective. Now, that will only continue to grow, and it'll continue to escalate, and it'll continue to get more and more and more. So this, to me, is the big print. I think what Larry is really predicting was there would be a big crash coming, and then to counteract the big crash, they'd have a big print. And that's what we saw in 2008, right? 2008 crash, there was the big print, 700 billion. In 2020, there was a big crash, and then there was the big print, and another 10 trillion. And then there's another crash, and then now it's 20 or 30 or 40 trillion. And that's the big print. But to me, I think it's more of a process, not an event, not a smooth line. But you know, if there's any type of, because the system is so over leveraged that moves happen very quickly. So, you know, we could easily see a 20, 30, 40% drawdown, but I think it would be dealt with so quickly and so swiftly that it's a non-tradable event.
Gotcha. And so, yeah, that makes sense. And I think it's a great point. The process, things are already happening and unfolding right in front of us. How do you think an everyday person, someone who's watching this show, can sort of, plan for what's ahead and, make sure they're protecting themselves, their assets, their family's future?
Yeah, it sort of depends on what boat you're in. So I'd say, number one, you got to buy assets, like, obviously. So, like, first of all, think about your income, and can I get my income up enough to start buying assets? So, like, if you're like living paycheck to paycheck, like, fix that first, obviously. Like, figure out how to go make more money. Now, hopefully you're making enough money and you're able to save some. Then what are you saving it in? So, sort of going back to the Michael Saylor example in 2020, he's like, hey, I have $500 million, but what do I do with it? Because everywhere I go, it's losing value to the rate of monetary debasement. And so then the next step is, where do you put it? Now, the rate of monetary debasement over the last 5 years is about 10% a year. So that means that it's not CPI inflation of 2.5% that you have to beat. That's not your hurdle rate. The real hurdle rate is the 10%. So then you just go, okay, well, what are my options to beat 10%? And you don't really have very many of them. Obviously, Bitcoin has been the best performing asset in the last 15, 10, 5, and 3 years. And so Bitcoin is an asset that beats that hurdle rate. So that's number two, is find, one, save money, two, buy an asset that can beat the hurdle rate. To Larry's point with the big print and the way I see it, I'm guessing the rate of monetary debasement only escalates from here. And so then what's that asset that I can beat that can keep up with that? If you look at, like, say, the S&P 500 and the median home in the United States, they're both perfect proxies for inflation. So they go up at the rate of inflation. So you're not really losing your purchasing power, but you're not gaining it either. So that's step number two. And then I think then the next step, as you get smarter and you're more educated and you have more assets, is you need to switch. And this is I actually recorded a video on this yesterday. Most people don't even think about money at all. Most people don't even live on a budget. They don't even know what a budget is. But for the people that are trying to do it smarter, they're living on a budget. And so we think about, this is the way school doesn't really teach us, but if you learned anything in university on basic economics, you would try to run your household on some sort of a budget. So you'd look at your P&L. Here's how much money we brought in. Here's how much money we spent. Here's what the profit that we had left. And then you try to invest it. So I'm going to put it into a home and that'll be my retirement, or I'll put some into my 401k or my S&P 500, or I'll put into Bitcoin or whatever. So I have my income minus my liabilities, and then I have my asset. But what I believe, if you really want to get ahead, and in the case of a big print, it's going to be, how do I keep up? That's going to be the problem with the debasement, is you need to think more like a treasury company. So when Michael Saylor had MicroStrategy, he ran it like a P&L. We have a software business. Our software business brings in this much revenue. We pay out this much expenses. We have this much net profit. But he changed the company from MicroStrategy to Strategy. And Strategy is not a P&L-based software business. Strategy is a treasury business. And we can all run our own personal life like a treasury. So instead of running us on a P&L budget, we should be thinking about, how do we activate our treasury? What are the assets on my balance sheet, and how do I activate those assets to grow my wealth even faster? You do it with the same two tools, which is 1, leverage, and 2, arbitrage. So how can I run my own personal wealth like a treasury strategy? Well, the same two tools. I can use debt and leverage. So for example, Michael Saylor went, as I said, right, his market cap was 3.6 billion. It's 100 billion today. He did that with debt. So he used capital, public markets, and took on debt to buy Bitcoin. The amount of debt he was paying was less than the compound annual growth rate of the Bitcoin. So the Bitcoin is growing faster than the rate of debt, right? He also did it by selling equity. So he sells the MSTR stock at the market, the ATM at the market. So if you're a small business owner or a business owner, you have tools. You have credit lines that you can get from your bank. You have credit cards that you can get. You have a business. You could sell equity. Even if it's a small private business, you might be able to find a private buyer to buy 20 or 30% of your business. Maybe you have $1 million business. You sell 30% of it for 300 grand. You could buy Bitcoin with that. Same thing he's doing. If you're a W-2 employee, just your regular homeowner, maybe you don't have the private business, but you still have equity. You still have credit and equity. So pretty much everybody could go to the bank and get a line of credit. They could probably apply to get a $100,000 credit card with a 0% introductory rate for 12 months. They could roll that every year. Hopefully they have some equity, maybe equity in their home, equity in their vehicles, so we all have that. Now, if you're broke and you got no credit, then fix that first. So I'm not talking to that person. Ask ChatGPT how to clean up your credit. Go do that. But most of us, even as a homeowner, right, we have access to capital. We have access to equity. And if we think more about the balance sheet, and we think about wealth, and we think about the game of wealth, that's how we're going to get ahead.
Gotcha. And like you mentioned earlier, it's definitely just important to also really understand the type of leverage you have, and make sure folks make sure you use that responsibly as well. But if done responsibly, could be a very useful tool.
That's worth a disclaimer, but at the same time, if you're listening to the show, it's like, don't go in the water because you could drown. Don't do it. Don't go near a pool. Don't go near an ocean. You could drown. You could also just learn how to swim. You could also get a life jacket before you get in the water. You could also make sure there's a lifeguard there, right? And so it's like, sure, right? Don't do things beyond your ability. Definitely. Learn from my story and my mistake in 2008. Don't do things beyond your ability. Even if you know how to swim, doesn't mean you should go swim in Hawaii where the waves are 30 feet, right? Now, there's 100 people surfing out there every day. They don't die. But that's because they've built up their skill set to manage that risk properly. I like to say that the risk is in the investor, not the investment. So even though if the average person went and swam in Hawaii, they would drown because the waves are so big, but hundreds of people go surf out there every day and they don't drown. So yes, it's worth the disclaimer of like, hey, don't go beyond your ability. But that's how life is. That's how life works.
Gotcha. And do you think there's a way for today's Fed to avoid a big print in the future, or are they just too far down the hole at this point? Is this system just too levered to the T, too far gone at this point?
Yeah, the system's too far gone at this point. I mean, basically, what happens is there's four outcomes when a country gets to this level of debt, and so the first option is what's called austerity. Austerity means you live on a budget. So right now, the U.S. government, and not just U.S. government, all the developed countries of the world, but the U.S. government is spending about $2 trillion more per year than what they bring in, right? So that's like you make 100 grand a year, but you're spending 150 grand a year. So the 50 grand a year is coming from your credit cards. Now, you might go, shoot, I got to get rid of this payment, and get back on a budget. But the government, how could they do that? How could they cut $2 trillion a year of spending? That means Social Security, Medicare, Medicaid. That means defense. That means all the social welfare programs. Like, no one's ever going to vote for that. Like, austerity is not a real option. And when you understand that really just the big three, which is like defense, debt service, and entitlements is like basically the whole budget. How do they cut that, right? Like, again, no one's ever going to vote for that. You also have to understand, like, the government's not a monolith. The government's made up of hundreds of lawmakers and, essentially we, the people, voting for those lawmakers. So no one's ever going to vote for austerity. So that's really sort of off the table. The next option is to default. So they could just default on the debt and just say, we ain't paying. But no country in the world with a money printer has ever done that, nor would they, because then no one's going to buy the debt, which they need because they can't stop spending. So then the default isn't really an option either. The third option is they could try to tax and grow their way out of it. And so you see a lot of rhetoric online of, tax the billionaires, take all their money, this and that. But even if you took all the 1%'s money, I mean, it's going to fund the government for like a couple weeks, maybe at best. So like, that's not really an option either. And there's, what is it called? Is it the Laffer curve?
This is our only option left.
The Laffer curve, I forget, but it basically shows that the percentage of revenue that the government brings in on taxes as a percentage of GDP stays the same regardless of what the tax rate is. So what they could take the tax rate up or they could bring the tax rate down, but the percentage of taxes collected of GDP stays the same. What happens is when taxes go up, the pie gets smaller. So they make a bigger percentage of the pie, but the pie got smaller. When taxes go down, the pie gets bigger, but they take a smaller percentage, but the pie is bigger. So the percentage of GDP stays about the same that the government gets. So that's not an option. So then, we get to the last option, which is just keep printing. You just keep printing. Now, the playbook is established and it's already been run. So the IMF and the BIS have both put out white papers. You can just look this up. You could link to it in the show notes down below. And there's a white paper called The Liquidation of Government Debt. So you can look that up and you could read it. You can have ChatGPT decipher it for you. But basically what the liquidation of government debt is explains by the BIS and the IMF on how governments can liquidate their debt when they get to these high levels of debt to GDP ratios like we're in right now. And not only have they published the white papers, I think it was published in 2015 and 2016. You can look those up. But they've actually run this playbook before. And not just the U.S., other governments have run this as well. Israel ran it in the 80s. The U.K. ran this, and we ran it as well after World War II. When the debt to GDP, you have to understand, debt to GDP ratio right now, it's over 120%. But that's a ratio. You have debt and you have GDP. So there's two ways to do this. One, I could bring the debt down. That's not super likely. Two, I could bring the GDP up. And by bringing GDP up, even if debt keeps growing, if I can get the GDP to go up faster, I can change the debt to GDP ratio. So what the liquidation of government debt is essentially explain how to do that. And again, they've done it a couple of times. And that is by letting inflation run hot, we can push the GDP up faster than the debt and bring our debt to GDP ratio from 120 back down to 90 or 80 or 70. So, for example, an iPhone is $1,000. the way the GDP works is it's like measures the total amount of gross domestic product. But an iPhone is $1,000. If inflation pushes the iPhone up to $1,200, now we have more GDP, even though more iPhones weren't sold, right? And so what they do, the liquidation of government debt, is to liquidate bondholders. So basically, inflation has to stay over the amount that the bondholders receive. So I'm going to pay you 4% to buy the Treasury, but inflation is going to be 6 or 7%. And by doing that, I'm liquidating my debt. And again, like I said, it's been done in the U.S. and after World War II. It's been done by the U.K. Israel ran this in the 80s, and that's the way they're going to get out of this. And so, to answer your question, the inevitability is to print, let it run hot, the big print, whatever you want to call it, but it's the liquidation of government debt.
Gotcha. And so, but who would buy those bonds, right? Like, if you're in that theoretical example, you're losing 2%, like, who would still keep buying those? And then would you say that, since this is a, playbook that has been ran before and we see that inflation's obviously been running hot, the Fed still isn't at its 2% target. It doesn't really look like it's getting there. They're even talking about maybe, well, they'll, 3% is the new target. Do they, even though Powell comes on TV and he's like, we got to get this inflation down, do you think even like, the real plan behind the scenes is like, hey, we're just gonna run this thing hot?
So let's start with yes, they're going to let it run hot. Like I said, I laid out their choices.
Yeah.
So I mean,
So
it's what are they going to do, right? I think if you think about both sides of this, right? So like the opposite of inflation is deflation. So deflation means prices start coming down. Now, you and I would be happy if my dollar bought me more goods and services in the future, but not if you don't have those dollars. So I would guess if you asked, if you took a vote in America or any of these developed countries, I would guess if you took a vote, would you rather, and let me just ask you, would you rather you see your asset prices double and the price of gas and food goes up by 5 or 10%? Or would you rather see all your asset prices cut in half, your pay cut in half, but prices come down 5%? Which would you rather?
Would want the former.
Of course, everybody would. Everybody will choose that, right? Nobody wants deflation. And so we think of it like, oh man, it'd be great if food got cheaper. Yeah, but what if you don't have a job anymore? What if your business has no revenue anymore? Right. And because what happens is once the deflation starts happening, all that debt, remember, as I said, it's collateral for more debt, all starts getting wiped out. So deflation is the end of the system. Deflation means the central bank is gone. The governments are gone. That means massive civil unrest. That means people on the street starving to death. Like, I think everybody just wants a little bit more inflation.
Okay. And then the piece on the bondholders. So
so who keeps buying it? Well,
yeah.
There's still a lot of buyers. First of all, it's somewhat of a trap system. So you have pensioners, so you have people whose government plans and money's trapped in pensions, all of that buys it. But you also still have sovereigns. So, when you're a sovereign nation and you have hundreds of billions of dollars, like, where do you put that? Where do you put hundreds of billions of dollars, right? And so the chance of just losing 1% a year isn't so bad, right?
Mm-hmm.
And then you have the forced buyers. So then over time, what we've already seen and we will continue to see is there will be less buyers for that. Sure, right? As more and more people realize this, there will be less buyers. When Russia had their bank accounts seized after they invaded Ukraine, that put the whole world on notice that your money's not sovereign. You can have your money seized. And so there's less buyers for it. And so over time, there are less buyers. Both China and Russia have been de-dollarizing since 2013. So over time, there's less and less buyers, which this means that the Fed, remember I said they started buying again?
Mm-hmm.
The Fed has to start picking up the slack and start doing the buying.
Okay. And we are seeing, global liquidity pick up. This cycle, for whatever reason, Bitcoin hasn't kept up with global liquidity. There's some people who have mapped out, correlations in the past. Why do you think that Bitcoin hasn't kept up yet? It's sort of an unusual lag. So what do you think is going on there? And do you think at some point it will catch up?
Yeah, so I think yet you said the word yet. I think that's a key word, yet. And so what happens is people are too fixated on short-term timeframes and not able to zoom out. And so, people are trying to understand daily moves in the market and why did the price drop today? Like, you can't really tie things back to that. And so back to that word yet. A couple things. Number one, it's not just the amount of global liquidity, which actually it's not just the amount of global liquidity, it's the rate of change of the amount of global liquidity. So even though global liquidity has still continued to expand, the rate of expansion has greatly diminished. That's number one. Number two, in the United States, we had a massive liquidity pocket, as I talked about. So the main driver of liquidity in the United States is the fiscal spending. So Lynn Alden says that nothing stops this train, right? She's talking about fiscal dominance, meaning the fiscal side, that means the government spending, the Treasury spending is dominant, and the Fed, the monetary policy, doesn't really have as much importance or influence because the fiscal side is so big. It's spending so much. As I said, $2 trillion more per year. Well, right now it's about 1.8. But that stopped. The longest shutdown in history stopped the fiscal spending. She said nothing stops the train. Well, the train did stop. It stopped for what was it, 56 days or whatever it was, right? It did stop. So that caused it. I think there's a couple other things. So since the launch of the ETFs, the volatility of Bitcoin has dropped a lot. Crypto's way down as well as a whole. And so when volatility drops, two things happen. One, complacency sets in. So you get traders, not really investors, but traders who then try to make up for that loss of volatility with leverage. So you have a massive amount of leverage that got built up in the crypto market overall and in Bitcoin. And so it's sort of like putting a whole bunch of like kindling, like fire kindling in, getting it ready to go. And so it takes a spark. Like we haven't cleared out the underbrush in 5 years, and one spark, the whole thing lights up. And so we had started building up all this leverage. And as that leverage is getting built up, the kindling, the dry brush is being there. Then we have this period of low liquidity because the fiscal spending, the government had been shut down. Then on top of it, Trump put out a tweet on October 10th, and he said that we're going to tariff China 100%. And just like when he did it in the first quarter of the year, it crashed the markets. So you had this very fragile market with all this liquidity built up in the system, all this kindling, low liquidity environment, like it's summertime. It's not wintertime. It's summertime, no rain. And then all of a sudden, you get this tweet that you're going to put tariffs up 100%, and it crashed all the markets, S&P, NASDAQ, everything dipped. But when it dipped in Bitcoin, it just started off this cascade of liquidations across all that leverage that had built up on the system. On top of that, you have JP Morgan that seemed to bring the lighter to the party. And the same day on October 10th, somehow maybe they knew about Trump's tweet, I don't know. But on the same exact day, they changed the margin requirements on MSTR. So MSTR stock, MicroStrategy stock or strategy stock, is the institutional equity-based proxy for Bitcoin. So it's a leveraged way to play Bitcoin. It's a 2 times volatility asset to what Bitcoin is. It's one of the most heavily traded stocks in the world. And on the same day, they changed the margin requirement from 50% to 95%. Now, they didn't do it across the board. They didn't do it to other crypto or other Bitcoin businesses. They didn't do it to Coinbase. They only did it to MicroStrategy. Now, what happens is when you take the most traded stock in the world, one of the most traded stocks in the world, that's a highly volatile, highly leveraged play to Bitcoin, which is already a volatile asset. And traders are doing it with leverage. All the leverage has been built up the system. And you change the leverage requirement from 50 to 95%, that triggers a margin call on the entire market. And when margin calls happen, then you have to start liquidating positions. And you add all that together, and we saw this massive cascade. I think it was like $200 billion was wiped out like immediately, right? So I think that led to a lot of the weakness where we're at. But, if we zoom out a little bit, well, let me finish with one more point. So then that happened. A little bit of, I don't have proof on this, but what's interesting, where there's smoke, there's fire. So they did change the margin requirement. They were rumored to have been dropping the news and maybe even pressuring MSCI to also delist strategy out of their index, which would then remove them from billions of dollars of funds flows. That was also another big piece of FUD that came out of MicroStrategy. So not only did I force everybody to liquidate their stock and change the margin requirement, then we start putting news out that brings it down. But then JP Morgan just released their own Bitcoin structured product that competes with what like MicroStrategy is doing. Almost like they wanted a better entry for their price before they brought out their product. Now, if we zoom out though, if you look at the structure, right? So the last low of the cycle was in 2022. Bitcoin got down to about $16,000. Since we've been going from 16,000 to hitting whatever the high of 125,000 ish, this is the third pullback of 30%, the third one that we've seen. So if we hold here, holding the $70,000 range, 35% pullback, we keep going. It's like you zoom out, it's not that big of a deal. In 2017, we went from $1,000 to $20,000 in 1 year. In just the last quarter alone, we went from, I think, 4,000 to 20,000. And in that time frame, I think there was 7 pullbacks of more than 25% in just a quarter. So to get 3 pullbacks of 30% over a couple of years is like really not a big deal for something like Bitcoin that I'm expecting it to go. I'm buying it. I'm expecting a 50 vol asset. I got to be prepared for a 30% drawdown. So in the big picture of things, and back to the word you used, yet, why hasn't it responded yet? Yeah, give it some time.
All right, great. And Mark, you started talking about Bitcoin treasury companies. You've mentioned Mike Saylor quite a bit here. You're involved in a Bitcoin treasury company, Satsuma, where you're the chief Bitcoin strategist. Can you talk about how you went from being a believer in just Bitcoin to now an investor and working at a Bitcoin treasury company? And then also, can you shed some light on your experience there so far? I know Satsuma has recently sold some of their Bitcoin, and maybe you could talk about the trade-offs that you and your team talked about and evaluated in terms of, de-risking and deleveraging on the one hand versus, maybe, having to sell some Bitcoin at a loss or sacrifice some of the future gains that you guys might have if you guys had held onto that Bitcoin.
Yeah, sure. So my path there, obviously, as I already said, 2015, I started buying Bitcoin. Being an entrepreneur, I started investing in Bitcoin companies. As I said earlier, I'm a partner in the Bitcoin fund with Larry Lepard and James Lavish. So we're investing money across the Bitcoin ecosystem. I was working with Trammell Venture Partners, which is one of the first Bitcoin venture funds. Then I helped launch Bitcoin Opportunity Fund with those guys. And so we're actively deploying money and helping the Bitcoin ecosystem grow. And then we invested into MetaPlanet, which was the first company to copy Strategy's play. And so we invested in that. It was an amazing success. And through the fund, we've invested into most of the Bitcoin treasury deals. And then as this entrepreneur, Satsuma is the second treasury company that I'm actively working in trying to help grow. So that's sort of the path of how I got there. So yeah, Bitcoin space, building Bitcoin companies, funding Bitcoin development companies, and then working with now these publicly traded companies. Overall, I think they're amazing vehicles, and we don't have time to really get into why I think the Bitcoin treasury space is going to be so big and it's undervalued. But to kind of get back to the point of the question that you're asking here, as far as the announcement of selling Bitcoin, that's not really what it was. So if you're paying attention to the news cycle of Satsuma, that came out, 2 weeks ago. The news that came out this week, a couple of days ago, was that we just got listed. We got our prospectus approved by the FCA. The FCA is the regulatory body in London, sort of like the SEC is in the US. The FCA approved the prospectus and we got our admission. So Satsuma, just like most of the treasury companies that we've seen, was a reverse takeover. So it was already a publicly traded company. The company, it was called Tau Alpha. It was a reverse takeover. The name was changed to Satsuma. We went and raised a private raise of money. We raised the money. Then we had to issue a prospectus, which is basically our business plan with the regulators. The regulators then have to go through this whole long process, and then finally approved it, and we get listed. Okay. So the listing just happened. So when you're talking about selling Bitcoin and there was no company. We just got listed a couple of days ago. So what happened is, in some of the investors that came in, some of the money, some of the investors brought in Bitcoin with them, not dollars, but Bitcoin. But per the terms of the regulatory body, we have to pay them back in dollars. So we had to sell some Bitcoin because we can't send Bitcoin back. We had to send dollars back to them. But that was all through the private, non-operating investment vehicle. The actual company just got listed a couple of days ago. Now it's an operating company, and the goal of the company is to never sell Bitcoin. So it's not really like, oh, we ran into trouble, ran into risk, we're selling the Bitcoin off, nothing like that. It was a non-operating business. That was just in the investment side of things. Now the business is approved. Now the business is running, and I don't anticipate any Bitcoin being sold.
Gotcha. Congratulations on the listing. I'm curious, now that you guys have uplisted, you have the company's formed, you guys are ready to run. How are you guys at Satsuma thinking about capital in the future and the growing the balance sheet in terms of strategy?
Yeah, so obviously there's a bunch of different avenues that we're going to tackle. I think one of the most attractive ones for us right now is that the LSE, the London Stock Exchange, is the premier listing in Europe. It's like being on the S&P 500 in the US. Now, being on that listing, so in the US, you have the S&P 500, and then you have the NASDAQ, and then you have smaller ones, and then you have like OTC listings, right? In London, you also have the London Stock Exchange. Below that, you have one called AIM, and below that, you have even one called Aquis. And what's funny is, surprisingly funny, is as we've been in London meeting with all the big institutional firms, a lot of them don't even know what Aquis is. It's like so small. It's just like a little listing just in London alone, but across Europe as well. But just in London alone, I think there's over like 25 treasury companies that have popped up, but they're all on these little small exchanges without any access to institutional capital. And even some of the bigger ones that we've seen, not to name any names, but bigger ones even in London and across Europe, they sort of stalled out and don't really have access to capital. And a lot of that, there's a lot of reasons why, the market cycle being one of them, but some of it is just not access to that capital. So being the only approved company on the LSE with institutional access, and access to get listed into what's called the FTSE, the top listed stocks, we can get the flows in there. That puts us in a unique position. And so one of the avenues that we're really pursuing is M&A, mergers and acquisitions. So there's a lot of these treasury companies that have stalled out. They're unable to raise capital. They're stuck on these small exchanges. They're never going to be able to, they don't have a direct path to get up there. I don't want to say never can, but they don't have a direct path to get up there. And so, and they're trading way below NAV, way below their net asset value. And so we've already identified many of these companies. We actually have conversations going with some big opportunities there. And so I think that's going to be a really big play, using our vehicle, our LSE premier listed vehicle being the only one, and doing M&A. So that's going to be one area, obviously. And then the other one is going to be raising money, of course. So we have some of the biggest institutional investors in London, and in the US as well. And so we'll be back on the road raising money as well. And the real goal is to get enough Bitcoin, right? So there's sort of like two stages of a treasury company. So stage one is grow the treasury. And then stage two is to leverage the treasury in a way where really you're doing like preferreds, in the UK, they're called preference shares. And that's kind of like the strike, strive, stride, stretch products that MicroStrategy has out, or Strategy has out. Strive Asset has one out now as well. And so really we need to get enough Bitcoin to get to that level. And then we can go to stage two, which is launching those preference shares. But that's the path. That's the plan that we're on right now.
Gotcha. And do you think there's anything, just speaking more broadly, that Bitcoin treasury companies could be doing to improve the playbook? So you talked about the suite of tools that are available. MicroStrategy started off with free cash flow. They then use some debt, some convertible notes. As you talked about, there's a progression, and the goal is to get to these fixed income securities, preferreds. Maybe you do some M&A. But do you think there's anything else that can be added to the model as you start to see more consolidation in the market, and as treasury companies look to sort of get to that next level of what they're trying to accomplish?
I mean, you basically have debt and equity, right? So there's a million ways that you can slice and dice debt or equity, but really those are the two tools: is debt and equity. Preference shares are equity, but it's really debt, right? Because you're bringing in money and then you have a coupon that you owe. So I think, as I said, I think leveraging the debt and equity markets are the key. Our equity, we can use the M&A route, or we can raise more money. It's kind of the same thing. Whether we give up stock for the Bitcoin, or we raise money and we give up stock for the money and then we buy the Bitcoin, it's kind of the same thing. That's why I'm just generalizing. You have debt and equity. Those are the two tools that we have. And those are the ones that I think that everyone's going to have to go after, right? Those are the only two options.
Wonderful. And Mark, as we look to wrap here, maybe we can leave with something a little bit more fun. Beginning of this year, so many people, especially in the Bitcoin space, were really excited about this idea that the U.S. and other nation states might adopt Bitcoin. What's a year later? What's your view on that issue? Do you think within the next couple of years we'll see the U.S. actually start to buy some Bitcoin, or another big nation state start to add Bitcoin to their balance sheet?
Yeah, I think that the U.S. is obviously has been working on that, but it's not like the biggest government in the entire world, the biggest with the reserve currency of the world, just flips on a dime and within a couple of months starts buying Bitcoin. So it's a process again, not an event. So yeah, I think they're going to continue to work on the sovereign wealth fund as well as the strategic Bitcoin reserve, and there are numerous countries that we've seen dropping announcements of buying Bitcoin just recently. I think the Czech did. I think we saw another Eastern European, maybe it was Poland. So we've seen a couple announcements coming out. Some people that I know that are very connected have said that there's a lot of it happening, that it's just not all being announced. So I would expect that to continue over time. I mean, eventually it's all coming. I don't know if that's worth getting too excited about and watching too heavily. I was having this conversation, a private conversation the other day, and they were saying, yeah, Bitcoin's kind of sold out and it's gone too corporate and too institutional, and now it's for governments and blah, blah, blah. It's like, it was always coming for everything. If you believed in this Bitcoin future, then every single person, every single business, every single government, every single institution is going to have Bitcoin. So it's not that it's getting too institutionalized. So it's going to happen. But the thing that I think is important to understand, I'll wrap it up with this, is that everybody, you and I, everybody needs Bitcoin. Every business needs Bitcoin. Every Wall Street institutional fund needs Bitcoin. And every government needs Bitcoin. But Bitcoin doesn't need any of them. Bitcoin doesn't need governments to adopt it to be successful. And it doesn't need institutions either. So it's a one-way street. So I don't think there's any big hope or reason to, hang your hat on, every government announcing they're going to start buying. Treasuries are buying. Treasuries are buying way more than governments would buy right now. So we have a constant bid underneath it. The evolution of Bitcoin is continuing to grow. The penetration through markets across the world is continuing to grow, and governments will eventually buy it.
Okay. Wonderful, Mark. Well, thank you so much for all the insights today, and for being generous with your time here. Where can the people go to find, more about what you're doing, and continue to keep up with your journey and your different companies?
Yeah, I mean, YouTube is probably the best place to find me, or you can just type my name in Google. But I put out a couple YouTube videos a week. Just search Mark Moss. Like I said, the one talking about switching from a balance sheet, from a P&L to a balance sheet. I just did that video. It'll be out on YouTube here like in a week. So check me out there.
Okay, wonderful. Thanks again, Mark. Really appreciated it. Take care.
Thank you.